I've got the signal to start now. So it's my pleasure to have here two high-level representatives of the ECB and of the Commission. So from the Commission, Mrs. Alexandra Jour-Schroeder, Deputy Director-General at FISMA at the Commission, and John Fell, Deputy Director-General at Financial Stability and Macroprudential Policies at the ECB. So as usual, as we do every year, we'll have a presentation of the respective reports of the Commission and the ECB on financial integration. And I think we start actually with John for his presentation, followed then by some Q&A, and then Mrs. Jour-Schroeder, and again a few Q&A. So John, the floor is yours. So I assume everything is ready from a technical perspective. So you can stand there in front of a lectern. And let's see. Yes, everything seems ready.
Am I waiting for a signal? Good morning, everyone. Some people here will know me from my work on our financial stability review, and that I'm often the bearer of bad news. But today, we're publishing our financial integration and structure in the euro area, our FISMA report. And for me, this time is different. We think we have some good news to share. In a sentence, financial integration in the euro area has improved. That said, and for those who felt that one might be coming, I can confirm that we do have a few buts, and they are important and well known. Europe is still not managing to convert its large savings base into scale, into risk capital, and into cross-border investment as effectively as we think it could. So as everyone here knows well, it's this gap that the Savings and Investment Union, or SIU for short, is aiming to close. So this is our fourth, and I spelled out the acronym once, I won't do it again. This is our fourth FISMA report, and it does two things. First, it takes stock of financial integration and structure using a standard set of indicators that we've been using in our financial integration reports over the years. And second, it looks at practical policy areas where the SIU can make integration more useful for households, for firms, and for markets. Now, the first part of my presentation will be about diagnosis, and it aims to answer questions like how integrated the euro area financial system is, how its structure is changing, and whether the integration that we see today is resilient. So, elaborating on my opening message, both our price-based and our quantity-based composite indicators, you can see them there on the left, they show significant improvement in euro area financial integration. Over the past 2 to 3 years, progress had been disappointing before, and this is why this time is different. So in plain terms, prices across markets have moved more closely together, and cross-border holdings and diversification have increased. Now, the price-based movement is broad, and it's across bond, equity, and banking markets. The caveat, though, is that the money market sub-index covering the unsecured segment has been more volatile. So I think we can safely say that integration has strengthened, and not only in one market segment, but the picture is not perfectly uniform. And I think that echoes what the Vice President was saying in his Q&A. So our second message is more cautious. Since 2003, external financing by firms, by households and governments has weakened. Higher borrowing costs, uncertainty and cautious sentiment have pushed firms and households towards internal resources. So what do we mean by that? Financing themselves out of internally generated cash flow, and also deleveraging. Governments moderated borrowing as fiscal consolidation progressed, as we well know. But there is also an integration angle. Non-domestic, intra-euro area providers gained prominence, especially in marketable debt and in listed shares. So the charts here therefore tell us, I think, two stories at once. Financing needs were subdued, in line also with what the Vice President was saying, but capital market financing became more cross-border within the euro area. So the financial structure itself is also changing. Financial assets as a share of GDP actually declined slightly over the period of review. And of course, the composition shifted as well. I mean, this part is well known. Central banks reduced their share as quantitative easing came to a halt and started reversing, while non-bank financial intermediaries, or NBFIs as they are known for short, gained prominence. So investment funds, insurers, and pension funds have been central to this growth. And that matters because NBFIs can support cross-border risk sharing and market-based finance. But the right-hand side chart adds another, and we have one almost every time, an important caveat. Investment funds allocate around half of their assets, outside the euro area. So on the one hand, and that relates to the very tough question that the Vice President got at the end. So on the one hand, we could see that in a glass half full way as useful diversification. But it also shows that Europe's own capital markets are not yet attractive enough or deep enough to absorb European savings at scale. Now, nearing the end of this segment of my presentation, this slide is the bridge. This slide is the bridge to the policy part. So we also ask in the report whether integration is high quality. And whether it's resilient. Equity and longer-term finance are generally more shock-absorbing than short-term debt is. It's harder to, I mean, you have to roll over short-term debt. You don't have to with those other instruments. So here the report finds a mixed picture. Debt market integration has improved, supported by a greater willingness of euro area investors to hold longer date bonds from their jurisdictions, but equity market integration has weakened, and intra-euro area foreign direct investment has fallen to historically low levels. And that is why the SIU matters. The challenge that we face is not only to secure more integration, but to secure better integration. What does it take to make the savings and investments unit work? So the question, I think, it's really a practical question. What has to change for Europe savings to finance European investment, innovation, and to scale more effectively? So the SIU chapter is it's evidence-led rather than impressionistic. And I mean, I think we did some novel things here to prepare it with the support of large language model technology. We collected 172 public commentaries on the SIU, and we extracted from that data 1,292 priority statements. Now, those were classified into 18 priority categories aligned with the Commission's SIU framework. And I think, the findings, I think, were interesting. The highest ranked areas, as you can see there, were supervision, retail participation, cross-border investment, pension systems, post-trading infrastructure, venture and growth capital, and tax barriers, which we actually devote quite a bit of space to in this issue of the review, tax issues. Now, while it was able to do two things that no human or even a small team could ever do in the same amount of time, I think this is not the story in itself, of course. We think the important point here is that the chapter focuses on the issues that market participants are repeatedly identifying as the binding constraints. So, where they think the action really needs to happen. So supervision, as you saw, came out of this exercise as the top-ranked priority. And and we document a strikingly fragmented landscape. 52 national authorities and 16 institutional setups. And even where EU rules are formally harmonized, supervisory practices and enforcement can differ. So that raises costs for cross-border firms. It weakens the level playing field, and it creates scope for regulatory arbitrage. Now, the policy message here is not that national supervisors should disappear. That's not what we're saying, but rather it is that large cross-border players and inherently cross-border sectors need more integrated EU-level supervision if capital markets are to become genuinely European. Now, tax is the second structural friction, and as I said, we devote a lot of space in the report to this. I just need to get some water, which I didn't have with me. Apologies for that. As I was saying, we devote a lot of space to tax issues, and corporate tax rules, withholding tax procedures, and administrative requirements remain fragmented across the EU. And we're careful here with our language, with our messaging, and we don't pretend that full tax harmonization is around the corner. Instead, we point to some practical steps. FASTER, so the acronym for Faster and Safer Tax Excess Relief, should be transposed into national law by the end of 2028, and it should simplify withholding tax relief. But intra-EU cross-border investment may still remain costlier than domestic investment. So we have, box 2 of the report explores an optional harmonized tax area within the EU as a possible way forward. And it starts with willing countries. So this is relating to the question about the 28 regime in a way, starting with willing countries rather than waiting for full unanimity. Now, turning to retail participation, I have to sometimes cross-check because my eyesight is not always perfect that I can see. So turning to the retail participation, this is really central because Europe has plenty of savings, but not enough of those savings are reaching productive risk capital. So to give some figures supporting the slogan that you will often see on social media and elsewhere, that Europeans are great savers, but they're not so good at investing. Euro area households had a savings rate, and these are putting figures on what the Vice President was saying as well. Euro area households had a saving rate of 15% in early 2025, and that compares with a significantly lower investment rate of 9%. So hence the current account surplus that he was explaining. Now, at the same time, deposits and currency make up 32% of household portfolios. Now, to put that into perspective, the comparable figure in the US is 11%. And think about it, that's low yielding, interest bearing, and then you kind of wonder why. I think it answers why US savers, actually US households don't even have to save as much as Euro area savers because they're getting that extra return from investing in higher yielding assets. Now, for direct listed shares, the difference between the average asset portfolio of European and US households, I mean, this is even more striking. They represent just 5%. So this is the amount of households that are holding actual stocks, listed shares individually, not ETFs. So they represent just 5% in Europe. Now that compares with 31% in the US. So our message is we're not saying that households should be pushed into taking on unsuitable risk. But I think what we are saying is that simple, transparent products, and most importantly, and maybe this is where the US has a bit of an edge, financial literacy or financial awareness or financial information for retail investors, and well-designed incentives can improve long-term returns for savers, and it can also, well, I mean, taken together with some of the tax issues, it could even mean a lower cost of capital for firms. Now, we're coming back to taxes. This slide zooms in on taxation as a barrier to household and institutional investment. Withholding tax procedures differ across member states, and refund systems can be slow. They can be costly, and they can be so complicated that people just literally give up and they don't bother reclaiming withholding tax, double withholding tax, that they are actually entitled to get back, but because it's so hard with the paperwork, they just don't even try. Now, we cite a figure from the Commission's impact assessment. It's an impact assessment of the cost of inefficient withholding tax procedures. It reaches a figure of about 6.6 billion annually for investors in Europe. Now, that's not just paperwork. It changes behavior. Investors may avoid cross-border holdings because it's just so complicated to, be in Germany and buy a French stock, which, shouldn't be the case. And that, of course, reinforces home bias. Plenty of academic studies on why we have these home biases, and maybe it's not so complicated. Occam's razor. And of course, that weakens capital market integration too. So, I mean, we think, and we're big supporters of, we think faster will help, but we're clear in the report that streamlining procedures does not eliminate all of the double taxation frictions. So our overall message on taxation is nuanced. Lower tax rates alone, I mean, we don't think this would automatically create deeper capital markets. Several countries with high tax levels they also have highly developed markets. So, I mean, it's not, it's more complicated. There are probably some interaction variables there. What matters is design, simplicity, predictability, relief at source, and savings and investment accounts that are easy to use. Now, I mean, one example that we look at is the Swedish ISK. It's often cited because it combines simplicity, flexibility, and just simply straightforward tax treatment. The safe policy point, I think here, the one that we're comfortable with, is that tax incentives may help, but they should be designed to bring new savers into the market. We don't think, and we're not pushing to have changes that would merely subsidize existing portfolios. Now, we think one of the most important messages of the report, I just make sure I'm aligned between my slides and my text. One of the most important messages in the report is here. When euro area households do invest in equity, so that's the 5% that are investing in equity, half of their holdings are outside the EU. And US markets are capturing about 34% of that. I mean, that's probably not surprising, not so surprising. Now, we did an exercise. We estimate that aligning EU household deposit ratios with US households could redirect a figure, an astonishingly large figure of 8 trillion euro into long-term market-based investment. Now, we also find a sectoral gap. Euro area households hold about 292 billion euro in EU high-tech sectors. No doubt a big number, but at about 404 billion holdings in US high-tech sectors are even larger. So the bottom line here, I think it's simple. European savings are large, but too little of the risk-based capital is financing Europe's own scale-up and innovation ecosystem aspirations. Now, the next topic from the prioritized list is pensions, and pensions matter because they are long-term savings. Public pensions in Europe, I mean, as everyone knows, are mainly pay-as-you-go, while occupational and private pensions are funded in and they invest in capital markets. Now, the report is explicit that supplementary pensions complement, they don't replace public pensions. It also notes that the prudent person principle is not the problem in itself. The issue is inconsistent and sometimes conservative interpretation across member states. The Commission's package points to clearer rules, pension tracking systems, auto-enrollment, and reforms to IORP and PEP frameworks as ways to improve retirement outcomes and for mobilizing long-term capital. We also look at private markets in the report, and these remain small compared with public markets and bank lending. This is one of the topics that is in the news almost every day these days, but these markets have grown significantly in recent years. We think that they have a clear role to play in the system, to finance firms that may be too small, that may be too risky, or too intangible heavy. So they don't have assets to bring to a bank when they're looking for a loan. So public markets might be a better place for those kinds of loans than banks. Now we find that firms that are financed via private markets tend to be more productive, but they also have weaker risk metrics, and maybe you wouldn't be so surprised by that, particularly if they are those intangible backed kind of firms. Now, that's in a way the balance. Private markets can support innovation and they can support SME financing, but transparency, liquidity risks, and some of the issues that are in the FT every day these days, and interlinkages with the wider financial system have become issues, and we do think that they need monitoring. The venture capital market is another area that we looked at. We have a box on this, and I think this part makes the scaling problem that is often talked about very, very concrete. Early stage finance is more available in Europe than late stage scale-up finance. US venture capital firms, VC funds, they amount to about 930 billion. Now again, I mean, it's always the figures are larger for the US compared with around 150 in the US. And US funds invest around 6 times more. Now, ultimately, this affects Europe's IPO, so the initial public offering pipeline, and the ability of innovative firms to grow and to reach the point where they want to become listed on a public market. And we often see those really successful firms in Europe going to the US and listing on the New York Stock Exchange or NASDAQ. Now, the point is not simply that Europe needs more venture capital. We think it needs larger funds, deeper exit markets. So the moment where the venture capital investor no longer wants to be invested in the firm and wants to take profits, and the firm goes into an IPO. So we think it needs larger funds and also a less fragmented single market for scaling firms. Now, the investor base also differs sharply when we look at a comparison of VC in Europe compared to the US. In Europe, actually, government entities are actually central to the venture capital ecosystem, or the VC ecosystem. So it's quite different to the US. In the US, it's pension funds and foundations that play a much larger role. Now that means that the European Investment Fund is important as a hub and a credibility signal. But we also say in the report, we warn even that a concentrated network is not a mature private market ecosystem. So the policy implication is that we need to be crowding in more private investors, especially institutional investors, and reduce those cross-border barriers that are currently keeping VC investment networks too national and too narrow. On the regulation of venture capital, we ask whether the available frameworks fit the needs of European venture capital today. So, as an aside, the report is a bit of an alphabet soup of acronyms, but we find that 69% of matched EU VC funds are under the Alternative Investment Fund, or AIF, regime, with about 29% under the European Venture Capital Fund, or EU VECA, VECA, and 2% under the EU Social Entrepreneurship, another acronym, EU SEF regime. So, I don't know how to say, the Commission colleague could maybe tell us how we say it, but I say EU VECA. It covers a subset of the AIF space, and it's intended to be a lighter regime. But its use varies greatly across countries, and it remains marginal in some large markets. So we think that the upcoming review is an opportunity to make this framework more useful for larger funds and more useful for cross-border scale-up financing. Our post-trade infrastructure, frictions on post-trading infrastructure, frictions can be real issues. If issuance, settlement, asset servicing, laws, all the stuff that takes place in the background for the functioning of markets, and also tax processes, remain fragmented, then European markets simply become less attractive and less liquid. The EU has made real progress through CSDR and Target 2 securities, or T2S, the Eurosystem settlement platform, but cross-CSD settlement remains limited, and national legal and tax differences still matter. So here the Commission's market integration package and work on innovation, we think it can help, but a fully integrated landscape still requires tackling persistent fragmentation. Last but not least, and I hope I just check my alignment. Yeah, last but not least, on distributed ledger technology, or DLT. This is best explained as infrastructure for recording and for transferring tokenized financial assets. Here we say that around 2 billion of euro-denominated debt instruments with digital exposure were outstanding at end 2025. The Eurosystem's 2024 exploratory work tested central bank money settlement for DLT-based wholesale transactions. Nearly 1.6 billion euro in settlement, 64 participants, 9 jurisdictions, and 58 distinct use cases. Now, Pontes is the short-term bridge between market DLT platforms and target services, with a pilot from the third quarter of 2026. Appia is the longer-term blueprint for an integrated digital ecosystem by 2028. Now, there's also a monetary policy implementation angle in the report too for DLT. Since the 30th of March, the Eurosystem has been accepting marketable assets issued in CSDs using DLT-based services as eligible collateral, provided that they meet the Eurosystem collateral framework requirements and are available for settlement in T2S compatible form. The report also says that the Eurosystem is exploring how assets exclusively settled on DLT networks could become eligible in the future. So I think the message we have here is guidance, not hype. The Eurosystem is giving market participants a common framework while preserving adequacy, safety, efficiency, and a level playing field. Before I say thank you, let me close with 3 takeaways. First, financial integration in the euro area, as I said at the beginning, has improved, and we think this is good news. Second, the quality of integration remains uneven. Debt markets look stronger while equity, FDI, and scale-up financing all remain weaker than we think what Europe needs now. Third, the SIU agenda is about converting Europe's savings into investment capacity by removing a very long list of practical frictions. Now, we find them, I mean, I just went through it, we find them in supervision, we find them in taxation, in retail participation in pensions, venture capital, and also market infrastructure. So there's a lot to do. So we don't think, and I think this was the background of what the Vice President was saying in answering your first question, Gilles. We don't think the report is just a dashboard, though. I mean, so the aim, why do we publish this report at all? I think it's to offer a guide on where we think progress can turn integration into scale and savings into productive investment. And now I say thank you.
Thank you very much, John, for this very thorough and comprehensive assessment of financial integration. So we have time for a few questions, please. So under the control of Philippe. Okay, we have here someone here, please. And introduce yourself before asking the question.
Okay, so my name is Thorsten Müller. I'm representing EFAS, the European Federation of Financial Analysts. John, thank you very much for the very good presentation indeed. One point I was really missing about European financial integration is the European single access point. There's a lot of public debate. We try to bring down bureaucracy, and right now there's a story that the ESAP is about bureaucracy and we have to stop it. We think that ESAP is not about bureaucracy, it's about structural data, and it's one of the fundamentals of a really integrated savings and investment union. We think that it's important to have structural data for using artificial intelligence efficiently, because artificial intelligence needs precise data. And if we just collect data on PDF documents, that will not work. And further on, we also have to think of the US has been using the EDGAR system for, I think, more than 20 years. And it's still the top system we know. And right now, my concern is that the ESAP will be loosened or we will not implement it at all. So can you just give me your view about the European single access point? Thank you.
So look, I'm not an expert on this topic, but I mean, everything that you just said sounded very sensible. I mean, I don't know where it is on our prioritization exercise, Jens. Is it there? But I mean, look, I mean, the only thing I can really say here, because I'm not an expert at all on this topic, is that, data, you said something really important on data. Digital data, all of this is the future. So if you've now identified, and you're telling us, and I'm glad you did it because it's going to be on the record now, and maybe you get into, and next year next time you're in a higher place in that ranking, which was a long list of issues. But that sounds like something that we should be progressing in Europe. So there was nothing that you said that I found that I would find myself instinctively saying no. No. I mean, these kinds of areas are where Europe needs to match, if not exceed, what's happening elsewhere on the planet. You're going to come back on that. Although
no,
just out of PDFs.
Yeah, just one further topic I'd like to cover.
Yeah.
Everybody talks about resilience.
Yeah.
Europe is completely dependent on US data aggregators.
Yeah.
And we need to support the European single access point to become more resilient. That is really key. And so that is a really serious point. And I would be happy to go into more details with other people being in charge, but that is absolutely crucial. Thank you.
Okay, I'm glad you said that, because and I think it even relates to the point that was made on strategic autonomy earlier. Yes, I mean, this is obviously, and the Vice President was talking about mythos and the concerns around that, but I mean, I think it just again reminds us that there is this huge dependence on US technology in cyber security. I mean, it's not just, you know, that we all know that we use Microsoft and we use Google and all of that, but I mean, it's just everything. It's everything. You even PDFs. We don't even have a rival PDF, you know, business in Europe. So the US sets the standard, you know, in almost everything in tech. And that, you know, I mean, I was, you know, and why does that matter? I mean, I was doing some comparisons, thinking about, you know, how Europe has kind of fallen behind compared to the US. You know, 25 years ago, Europe was ahead in tech. We had some of the best companies. We had Ericsson, we had Nokia, we had, you know, we were the main sellers of mobile phones in the US. You know, we've forgotten that, but that, you know, that was the situation. So we kind of lost that. Over time, and that's, I think, a reflection of falling behind on some of the technological developments. And I think, thank you for raising the point, and I think we will, you know, you've given us something to dig a bit deeper into, so it's appreciated.
Another question, please, in the room or online? Philippe?
Yes, I think we would have one from the online audience that relates to private markets. So there's the question bit, I interpreted that international fora point to the risks of private equity, private debt markets, and here we call for Europe to develop actually private markets. Could you please clarify how these two things go together?
Yeah, so that may sound a bit schizophrenic, but it's not. And in fact, we will. I mean, of course, we are part of those debates, those discussions at International Forum. We will have something a bit deeper in the next issue of the Financial Stability Review on private credit, in particular, you know, to try and reconcile the two. I mean, we think, I mean, as I said in the presentation, there is a gap in finance that private credit can fill. Now, but you know, I think when we're talking about private credit, we really kind of have in mind what I would call plain vanilla private credit. So that's really where there is, you know, long-term lending to firms. It's not all this additional layer of BDC and all of this that create kind of, you know, the vulnerabilities of the kind that we saw in 2008. That part, but that part is much smaller, and that is where I think concerns have started to grow because of retail participation in private credit and so on, and its ability to create products that retail can access. But when you, yeah, I mean, we will have this, but in the report. But when you have, you know, when you compare the situation of today with the situation that preceded the global financial crisis, people love to quote the figure, oh look, private credit is now today in nominal terms just as big as it was, as subprime was back in 2006. I think the figure is almost exactly the same. It's around 1.4 trillion, so it's a great thing. Of course, GDP has grown in the US in the meantime, and that's kind of, you know, it's benefited from the denominator squashing the numerator, and we've got a lower fraction of savings. But the point is, I mean, in particular, the vulnerabilities that we found that were really important in the global financial crisis that caused everything to collapse were mature, you know, what I would call maturity transformation, funding long-term assets with short-term liabilities. That we don't see that in private credit. In fact, there's almost, you know, there's a perfect correspondence. People can't get their money back. You see this about redemptions now, but this is more about the kind of the marketable side of it. The second point is leverage. Leverage is much lower in private credit than it is in banks. You know, in many cases, it's like a deal is 50-50 credit and equity. You know, so it's a much lower ratio. So you don't have that kind of, you know, leverage creates a potential for an amplification mechanism. And then there is interconnection, which is a third big discovery from the global financial crisis. You know, we had this too big to fail before the GFC, then it became too interconnected to fail. yeah, there is interconnection, but it's largely with the more long-term parts of the market, and this is where of the financial structure. So particularly with insurance, but also pensions, and these firms, they create assets that are attractive to long-term investors like pension funds, and this is why, if it's managed well, it can be a win-win. But there's lots of intransparency. It's a private market, so they don't have to disclose what they're doing. They're not obliged, but all kinds of issues. And of course now, and I think what has kind of a bit caused the panic is that people are beginning to see that AI is real and that it's having an impact it's disrupting businesses. It's disrupting software businesses in particular, because you can just sit with your take Claude out and say, write me a software for, I don't know, this, and then you don't need to. Yeah, but this is why you see it, and that private credit is highly exposed to this sector. So I think that's one of the chief concerns. But I mean, yeah, overall, we don't see it on the same magnitude as 2008. I hope that answers the question.
I see time is running, so now I will pass the floor to Alexandra, please. You can join the lectern for the presentation of the Commission report, please. Thanks.
So, ladies and gentlemen, very good morning. Very happy to be in Frankfurt today. And today is also an important day for us because we are presenting our European Commission Financial Stability and Integration Report 2026. But before I come to that, I wanted to start by thanking the ECB this time, hosting in 26 this joint conference on European financial integration. I think it has become what I would call a good tradition. And I think it's really nice that we do this together, Commission and the ECB. And it's also always a very good opportunity to see where do we stand when it comes to recent economic and financial developments. And actually, there are quite a lot happening, and I will come to that in a second. I want also to thank John for his very insightful presentation, also to explaining the SIU matrix so well, so very well done. And for me is now to share with you the findings, give you a sneak preview, as I may call it, on our financial integration report. And I was asking some time ago my colleagues, why are we doing this report? Because there are so many reports, and is there really a need to have this FC report every day? But I think my answer is clear. It's a clear yes, because we think this report helps us a lot to inform policy discussions, especially about recent trends, but also to give a bit the bigger picture. It also allows us to highlight very specific topics that are in the focus of financial integration. And I hope it will also help to raise policy considerations that are relevant for financial services. So in sum, we really think that our report contributes very much to what I would call evidence-based policy making, which is very important. Also, to be very honest with you, I found it sometimes not so easy to do this report in springtime, doing a solid analysis that also covers the most recent developments. We are quite used to this now because we have managed quite some challenges. We had the COVID times that came also somehow as a surprise in 2020. Then, of course, very sadly, Russia's war of aggression against Ukraine 4 years ago. And these were always developments that, of course, had an influence on financial developments and economic developments. Actually, last year in December, I thought it will be different. We will sail into calm waters, but not so really this is the case, because again, the preparation of this year's report forced us to navigate through what I would call fast-moving geopolitical tensions and quite a lot of uncertainties, in particular, but not only, the US trade policy developments we also see coming back in the last days. But nevertheless, and taking all these developments into account, I'm convinced that the 2026 edition will be an interesting reading that will not only focus on events that sometimes change by the day, but allow all of us to grasp the bigger picture, while being, of course, mindful of the ongoing instability associated with recent trends. As time is rather short and you should have still an incentive to read the report, let me limit my intervention to some aspects I found very, very interesting. And of course, the report starts as usual with our overview of economic and financial developments over the last year, but this year we have chosen two specific topics we find of relevance. And the first is about financial conditions of non-financial corporations in the EU. Why did we select this topic? Because we think it is important in view of our policy agenda on promoting better finance for firms, especially as part of our competitive agenda to support growth and jobs in the European Union. And the second chapter, and there have already been some remarks on this morning, and we will follow this up in a panel, is a topic of equally pressing relevance. This is about to see how the funded supplementary pension landscape in the EU can be developed, can be improved, and there are various reasons for that, but we leave that for the panel later on. Where I think we will have a lot of important insights. Very briefly, a few comments on the EU economy. You see it already on the screen, where I think John already gave us a very good overview about the situation on financial integration, and I would agree there is also some positive news in this. And what we did from our side, we looked into the report from the previous year, 2025, but we have also taken into account the first quarter of 2026. And as I was already hinting to at the beginning of 2026, the macroeconomic outlook appeared favorable, with the EU achieving real GDP growth of 1.6% in 2025. And it was also good to see that this trend was supported by very robust wage growth and supportive financing conditions. However, as I said, we are now sailing in a bit more rougher waters, especially looking in the conflict in the Middle East and the subsequent energy price surge. And I think we have to be honest here that this has disrupted, at least for now, this positive trend. And of course, we will getting more intelligent by the day, but it is clear that the magnitude of the shock we now see will certainly depend on two main issues. How long will it take? How long will the conflict last? And what would be or not the extent of supply disruptions? But let's also stay positive this morning. But what is, of course, also very clear from the report that to strive in today's very complex and challenging global environment, the EU economy must bolster its resilient and indeed strategic autonomy. Vice President was already very clear this morning on that. And we also need to do much more to unlock our growth potential, because it's there, but it is remaining in the potential stage. So there is a lot to do, and this will necessitate a meaningful process and progress, especially on our competitive agenda, which is very urgent, but also about the successful and the swift implementation of the Savings and Investment Union. It should be swift, but it should also remain ambitious. Let's have a quick look in the risk to financial stability and financial integration trends, still our chapter 1. Here my message to you this morning is that risks to financial stability remain high in our view and of course have been intensified with the Middle East conflict. Among key concerns in this area is the potential for disorderly market correction. And we see this still as a major financial stability risk due to consistently low premiums in several risk assets and valuations that are susceptible to a sudden shift in market expectations. Another issue of concern is that we still see high public debt levels in several EU member states. That continues to be a significant issue. And two key developments here have escalated these concerns. First, the need for increased defense spending, which is absolutely necessary, as was already said this morning, but that has, of course, put quite considerable additional pressure on public spending. And second, again, the conflict in the Middle East is having a negative effect on economic growth, spending needs, and borrowing costs. And all these developments can have spillover effects where repricing of sovereign risk could affect the corporate and financial sectors via higher funding costs and rating downgrades. A few small words on the banking sector. Again, maybe starting with some good news. Short-term profitability looks favorable. The sector shows resilience. We can see that, but here again, potential risks to asset quality and funding liquidity. And indeed, there is the issue we were just quickly touching about maybe more increasing interconnections with NBFI, non-bank financial intermediary entities that may expose banks to heightened credit, market liquidity, and operational risks. But again, to try to stay positive this morning, I think it is fair to say, and the report is very clear on that, that indeed the euro area financial integration has strengthened in 2025. And then we will see what 2026 brings us, including geopolitical developments. And I think John has been so very clear on that, that there's not much for me to add. Let me look briefly and give you some ideas what are in the other two chapters on first financial conditions and then on the pensions side. On the conditions of non-financial corporates in the EU, we have basically looked in the report at the financial resilience of these companies, their funding structures, and of course also very important, the access to finance conditions. And here we have come to the conclusion that compared to their counterparts in the UK and the United States, EU non-financial corporates continue to rely significantly less on market funding. That is not a big surprise, but always good to have also some figures to support the message. And the report comes to the conclusion that only 70% of their funding today comes from market sources versus 38% in the UK and 44% in the United States. Domestic bank lending remains a dominant source of debt financing for EU non-financial corporates. And it is also important to say that the share of domestic bank lending has declined since the financial crisis, but it has somehow stabilized in recent years at around 46% of total debt financing. The dominant position of domestic bank lenders in funding non-financial corporations is certainly one of the factors behind the relatively low volume of startups and scale-up funding in the EU we desperately need. And there are a number of good reasons behind banks' hesitation to lend more to innovative business. But it is, of course, clear that the availability of startup and scale-up funding is an area where we lag behind in the European Union, and we really need to see and to make progress to foster a more supportive environment, especially in this area for our business growth and access to finance. And we have done that, and I will be rather short because John has so well explained the saving and investment union ideas. But this is basically our blueprint where we are taking measures to facilitate access to finance and allow firms to diversify funding sources. And this is a missed package. The Vice President was already speaking about. This is a retail saving account. We will have to do much more on financial literacy. And I can already announce, as we were speaking about venture capital and growth funds, that we will come soon with a proposal that somehow addresses this imbalance about the regime we indeed find not longer up to the current challenges we have. It has been done in different times. So the proposal will come as we have it announced in our SIU strategy in March. My last point is on the future pensions landscape. In here again, maybe I'm not too long because we will have in a few minutes the opportunity to discuss this with very high regarded experts. But I think I wanted to leave with you this morning here that we have chosen this topic for the 2026 report because we think it is a very pressing issue. And it's a pressing issue from various angles. I mean, first of all, I think there is indeed a necessity to see how a funded or asset-backed pensions can help retirees' financial security and also to allow them to have an adequate standard of living after a long period of hard work and now for their retirement. And at the same time, they reduce pressure on state budgets and would, of course, and that is the other win-win element I see here, channel long-term savings into productive investments where money is really needed. I think we have to be honest looking into the situation in the EU, and it's very different when you look into the member states' situation, the comparison. But it's a fact that pension assets remain modest and lag far behind our global peers. Again, I mean, if you look at the United States, but also in Canada, with large amounts and EU total pension assets around 32% of GDP. Of course, we have to be mindful that this is partly due to the structure of the European Union. We have a very heterogeneous landscape and pension assets very strongly across member states. But all in all, even if you say there are some member states who are better or doing differently than others, it is a true fact that the EU's pension asset base remain rather underdeveloped, and there are a number of reasons for that we will discuss in a few minutes. But one of the reasons, in our view, is clearly that there is still a very strong reliance on pay-as-you-go public pensions. This is the prerogative of the member states, but it would not mean that we should not look in the EU in ways how we can top up these pay-as-you-go pensions also by private elements. Some member states are doing better, and I think for others there is still a way to go. But maybe also in the interest of time, I leave this for our panel discussion. But what is certainly clear for us is that scale here again and equity investments are key factors to the growth of pension funds we need in the European Union. And for that, we have also done a number of key initiatives. We look in the regulation of the personal pension product, which didn't have a very, I would say, successful uptake, and also in the regime for occupational retirement pension systems. And again, we will come to that in a few minutes. But I wanted to close my presentation also with one important message. have to say I'm possibly repeating to a large extent what the Vice President was saying this morning, but honestly, I think we cannot repeat it often enough. And this is basically that many of the findings you will find in our report confirm for us a very clear need for acting on all levels to unlock the potential of our internal market, from tackling the barriers that really still stand today in the way of a truly integrated capital markets, but also the need to improve conditions for investment and to ensure more sustainable saving and pension solutions for our citizens who really deserve that. So with that, I close my sneak preview. I encourage you to read the report. It should be online by now. And I hope also it brings some interest. Thank you.
Thank you, Alexandra. I suggest we take one or two questions, not to drift too much from the time we have, but we still have time for one or two questions. Attendance raised. Philippe?
We would have one from the online audience. It's about the SIU, which has the aim to provide more productive investments, but research shows that listed companies reduce R&D to prioritize shareholder payouts. So maybe to provide your views on how this could be overcome, that more productive investment nevertheless takes place.
This is about what exactly? About
the SIU, and that it should lead to more productive investments.
Okay, I mean, I could speak an hour on that. But I think what is important to foster productive investment in the SIU, this is a collection of various measures looking at the offer side, the demand side, and that we overcome the many structural barriers we still see here. And again, I mean, this is easy to say and not easy to do, because it is often also grown over many years from special national situations. I think what we really need here is a bit of disruption, what was just saying on AI, in the way that we cannot continue if we really want to play a role as the EU in the global scene, but also for our citizens and for our economy. If we do this, okay, it somehow has always worked. We do a bit of fine-tuning here and there. Basically, in the end, we have a system that manifests what's already existing in the EU. Member states have to take their responsibility now. We have made a proposal that is subject to discussion, but we really need a big step, and we really also have to overcome national sensitivities in a way. Let's do this together as a European Union.
Any other question? One question here, please, sir.
You focused very much on bringing retail investors to the market. I fully support that. But when we look at another very important investors group, that's the insurance industry. And if you look at the life insurance industry with very long durations, that is an ideal equity investor. And when you look at the numbers, back some 20 years ago, the equity investment ratio of the life insurance industry in Europe was about 20%. Now it's down to 5%. Why does nobody talk about bringing the insurance industry back into equity markets? Thank you.
No, I think you have an important point, and I would not say that nobody speaks about that. I think the reason was basically that there was still very much the concern after we had the financial crisis that investment in equity can of course bring good returns, but it also comes with a risk. and therefore, in the long-term perspective, and also taking into account that this is policyholders' money, the approach was more conservative. Honestly, I think what we have now done with the Solvency II review that will enter into force early next year, there is already a shift, and some may even feel that we are becoming too risk-friendly because especially on the possibility to invest in equity, the Solvency II review foresees some alleviations without completely putting the boat upside down. But I think it's exactly for the reason you were referring to, that a good, let's say, monitored risk is useful in especially using the money as insurers for life with a long-term perspective to bring especially the volume also they master into this situation. So let's see how it goes, but I think what the approach we have taken, there are deviations from perhaps a bit overly conservative to having a good risk and opportunities balanced approach.
Thank you, Alexandra. I think we will stop here to keep time. So thank you to Alexandra and John for these two presentations of the two reports. I advise you to read these reports, obviously. So we have a coffee break of 15 minutes. And then, as announced previously, we have the fireside chat with Enrico Letta. We have the honor of having Enrico Letta here. And Rebecca will act as the moderator. So thank you again on this session. And let's have a break for 15 minutes. Thank you.